right, we're live. Welcome back, everybody. Happy Tuesday, and welcome to another episode of The Market Made Easy with the Maxwell Group. And today we are here with Dakri Sutton. Nailed it.
You got it.
Yes, you got it.
Perfect.
And she comes to us from Sutton Accounting and Tax. 2 for 2.
You got it.
Awesome.
Yes.
Well, thank you so much. And we are going to talk about everybody's favorite thing to pay. Taxes.
Yes.
It's so good.
Dakri is my accountant. So I am
My
vouching.
favorite client.
I know. And so it's really great to have you here. You're a wonderful accountant. And
Thank you.
I just really appreciate you. So I'm really glad you came on to the
Thank you.
show. We're going to ask you all kinds of fun questions about small business as it relates to tax season and what we should be expecting as a small business. And just go through some topics. So, Dakri, tell us a little bit about yourself.
Okay.
What's your background? Where are you coming from?
So I have a bachelor's degree in accounting. I have a CPA, and I have been in business for myself since 2000. So quite a while. And
Solid track record.
Yeah,
that's pretty solid.
I've been here in the Prescott area since 2007. So I work primarily with small businesses. I don't do a lot of individual tax, which most CPAs do. So I've kind of tailored my business to work specifically with year-round accounting clients who need payroll, bookkeeping, and then come tax time, we have everything organized, and I will do the taxes for my year-round clients. So that's kind of how I've structured my business, just primarily working with small businesses here locally.
Oh my gosh, you give me such peace of mind every year because I know that, way in advance, I'm getting a call if there's something that needs to be, addressed.
Absolutely.
I love that about you. Yeah.
Thanks.
Yeah, absolutely. So tell us a little bit about this year and what's different about this year when it comes to small business and what we should expect.
So there were a lot of tax changes with this year for 2018. And so we're starting now. Tax season went live yesterday. Everybody can start e-filing now. So everything looks different this year. The tax forms look different. And there's a lot of different deductions and changes. So as far as small business goes, the primary thing this year that everybody's talking about is the qualified business income deduction. And this is for pass-through entities. So this would be for sole proprietors or S-corps or LLCs that have small businesses. It does not pertain to C-corps that are taxed at the corporate level. It has to be a pass-through entity. So the tax is passed through to the individual.
Okay.
And they are looking at a pretty nice deduction this year, and 20% for these small businesses.
Solid.
And it is solid.
Makes
It's
me happy.
complicated though, and we won't get into all the detail, but it is, there's a lot of formula involved, and it is going to be important for these small businesses to work with an accountant who knows how to handle this deduction, or a tax program can walk you through it if you're using TurboTax and doing it yourself. But it is a great write-off. So basically, the last 20% of your income is going untaxed. So that's a great benefit for small businesses. They do start to phase out the credit, though, if you are in particular trades.
Okay.
They're called specific trades, and they're basically lawyers, accountants, financial people that the criteria is that your income is derived from one person's expertise. And so there's a whole lot of discussion right now, and the IRS is putting out a lot of clarification about who falls into this category. Because if you're in this category and you make over about $300,000 for all income sources on your tax return, you're going to start to lose some of the credits. So I won't go into a lot of the detail, but it is something, if you're married filing joint and you're in upward of $300,000, you may have a limited deduction for that, but it is a great write-off.
And is that total after expenses, or is that gross?
It's after expenses.
Okay.
Yeah. So it's basically everything that's going to be on the front page of your 1040 for an individual. It's going to be your W-2 wages, your net income from any business sources.
Okay.
So it's everything. It's dividends, interest, everything's included. It's looking at all of your taxable income, and that's when you look at, are you under 300,000 or over 300,000, and to decide if you're going to be phased out or not. So
so most people are going to totally qualify for this deduction.
Yes, they are, and so it's great. It's great.
Awesome.
But in addition to that, that's the big news for small businesses. But other than that, I just kind of wanted to give some reminders as far as other deductions go for small businesses as you're starting to compile your information for taxes. Don't forget about home office write-off if you are working from home. Keeping track of your utilities and repairs and maintenance for your home office. Don't forget about auto deduction. You can either do a standard deduction or actual expenses, whichever's in your best interest. There's, obviously all your supplies and anything specifically related to your business with licensing or things like that. So there's all the general stuff, your advertising, things like that. Just make sure you've got everything compiled and ready to put into your tax return.
Awesome.
So,
Okay. So I also was wondering, because I think some people that have been a sole proprietor or have an LLC currently, that's what they just automatically did because they really didn't consult an accountant. What do you think is the best move for most small business making, let's say, under $100,000 a year, using one of those pass-through entities? What would you say? What are the things they need to think about when considering maybe going into an S corp versus an LLC? I mean, what do they need to consider? Right.
Obviously, the easiest entity is to just be a sole proprietor, and so when most people start off, they're just, anybody can become a sole proprietor. It's very easy to administer. There's no extra things you need to do. Anybody can be a sole proprietor, and you file as part of your individual income tax return. It's just really simple. But as you get larger and you start to make more money, it is important to look at the different entities that are available. The most logical thing, if you're already a sole proprietor, is to just become a one-person LLC. So that's a limited liability corporation. There's a process with the Arizona Corporate Commission that you would go through to become an LLC. A one-person LLC is taxed exactly like a sole proprietor. You file just like you're a sole proprietor, but you do have some liability limitations that way. If you were, and that's what you have to look at when you start to decide what type of an entity you want to be. If you're getting large enough that there could be some liability involved with your business, it's important to cover yourself. That's obviously a legal field, and I can't advise much on that. But it is important to guard yourself, because as a sole proprietor, you're totally responsible in the case of a lawsuit. They can come over and take your personal assets, in the case of somebody coming after you legally. So an LLC would protect your personal assets, and they can only go after what's in the business name then. So so an LLC is a logical move as well if you just are looking at protecting yourself legally. The next step, and I am a huge supporter of an S corp. As opposed to a C corp. The S corp is a pass-through entity. So you would incorporate with the Arizona Corporate Commission just like you do with an LLC, but then there's one more form that you file with the IRS that elects S corp taxation, and you are basically still taxed individually because the income is passing through to the owners of the S corp. But there is some tax savings for an S corp. If you are starting to turn a profit for your business and you're looking to limit tax, an S corp is a great avenue to do that. There is more administration with an S corp. You have to operate as a corporation. You need to technically have bylaws in place and have corporate meetings and things such as that. Technically, I say.
If you're a
because
one-person S corp,
a
you
lot of
can't
people don't do
give
that.
yourself high fives at the
Yeah.
coffee
Exactly.
shop and call it a meeting.
Yeah.
Exactly.
Doing great. Things are looking good.
Yep. Sign those documents. We had our meeting, our
Meeting
annual
adjourned.
meeting. Yep.
Yeah, little trip to Vegas over the weekend
Yeah.
for the corporate meeting.
Exactly.
Love it. Yes.
So, so
Call
you
it a
do
retreat.
have to look at, if you have a couple of employees or shareholders, then you do have to be, more official with these meetings. On top of that, you do have to pay the officers a reasonable salary. And so you start as an S corp to have to run a payroll, where as an LLC and a sole proprietor, you don't have to pay yourself payroll. You can just take draws out of the company at any time. So as an S corp, you have to operate a payroll. And so some people don't want to do that because they have to hassle with who's going to administer it, and do I want to pay someone to do it? That's what I get paid to do by many people. So you have to do that. And you may, Carissa knows this term, but reasonable compensation is something that your accountant will talk to you about if you have an S corp. The key being you have to pay yourself as an officer a fair salary equivalent to what you would make if you were an employee somewhere else doing the same type of work. So, if Carissa's a realtor and, she wants to take a salary of $5,000 a year.
That's probably too
it's
low.
probably too low.
Yeah.
The IRS is going to say no.
Not for about 90% of realtors, right?
Right.
Yeah. 92%.
92% of realtors only do one deal a year.
Well, see,
if
that's
that. So
different. See,
that
it's
seems
based-
reasonable to me.
And it is based
I can make that
on
argument.
how many hours you're working, and are you part-time, full-time? So all
Right.
that's taken into account. The IRS just wants to make sure that you are paying enough into the Social Security system and Medicare. So they want you to pay payroll taxes is what
Gotcha.
it boils down to. So you have to pay yourself a fair salary. And then the tax benefit then is that any additional income that you have can be taken out as an owner draw. So then you're skipping paying the payroll taxes on any additional money that any profit that you have in the business. So, for example, if you have a net income of $100,000, you pay yourself a salary of $50,000, which has been determined by you as reasonable, then you can take out the additional $50,000 of profit and skip paying the payroll
taxes.
So that's a huge tax savings. So
Right.
Not the income taxes, but the payroll
the
taxes.
payroll
on it.
taxes, correct.
So if they were an LLC and they were just taking draws, they would basically be taxed on the income and the payroll for
Yes.
both.
Because you're paying self-employment taxes then.
So, okay, so it's either payroll or self-employment. So you
Yes.
choose,
Yes.
pick your poison. Which one do you want? What's going to be more cost effective for
That's
you?
right. That's
Okay.
right. Yeah. So keep in mind an S corp as you're becoming profitable. If you're a small business and you're currently an LLC, that's a great place to start. It's very easy to change to an S corp. Obviously, work with an accountant who can advise you and guide you through that process. But there are some perks to S corp for sure. So.
For payroll taxes, what is does it depend on the entity or on the business on what that percentage is?
Nope, it's the same across the board.
Okay.
It's 15.3%.
Okay.
So you basically pay, so if you were an employee somewhere, you're going to pay 7.65%, but since you're the owner and the employee, you have
Yeah.
to pay both sides
You
of
get
that.
both.
So you pay 15.3%.
Okay. All right. So
and
that doesn't matter what kind of
doesn't
business.
matter.
All right.
No, if you're taking salaries, that's the same percentage across the board. So
Okay. So, and then the personal income tax, if you're an LLC, is that right? That's what it's called?
right, and it'll be based on whatever your income tax situation is, and that
Okay.
can vary. There's different tax brackets, so it depends on your spouse's income, how
Okay.
much rental income, how much dividends and interest. There's all kinds of variables, so that's
Okay.
not a standard flat amount. It depends on what your income bracket is. So
Okay. Cool. Interesting.
yeah. The other thing that we had said we were going to talk about was
Yeah.
the tax credits.
Oh, yes.
Yeah, we don't
need
want to forget
know.
the tax credits.
Yes.
Yeah, so as you're thinking about filing your taxes, I'm sure more than one entity has already hit you up for a tax
Yes,
credit. I get it in the
nonprofits.
mail
Yes.
like every day.
Yeah.
Yes.
They all want our money, and it's a great avenue to put your Arizona tax dollars into many different types of organizations, charitable, schools. Basically, you can get a dollar for dollar credit for up to your tax liability for contributing to various entities. There's a public school tax credit, there's a private school tax credit, there's charitable organizations, foster agencies. Those are the main ones. And they all have different dollar limitations, but the great news is that a few years ago, they started allowing you to donate up until you file your taxes for the previous year. So it's very, very good to look at your taxes, figure out what you might owe or what you might be getting back, and then decide if you want to do that. You basically are redirecting your Arizona tax dollars. So our schools need it and our charities need it. It's a great thing to look at, and you can take it as a federal charity deduction as well.
Okay.
Yeah, but it's a great avenue.
And so, for instance, like let's say you tithe at a church and you give that throughout the year.
Right.
Is there a limit on how much we can donate on that, or is
No, yeah, that's different than the Arizona State tax credit. Those you aren't going to get a credit for, but you can donate. There's a very high limit for itemized or for charity. Now, I will say one of the big changes for 2018 is that most people aren't going to itemize their deductions this year. I think what I heard was 90% of people that have itemized in the past will not be itemizing this year because they just about doubled the standard deduction this year. So now everybody gets a $24,000 married filing joint gets $24,000 standard deduction.
Whoa.
So most people aren't going to need to be compiling the donations, the mortgage interest, the real estate taxes. We're not doing that anymore for
All
most
the travel
clients.
receipts and that kind of stuff.
Now, the effect of this is that people are not donating like they have been in the past because it's not a tax write-off now.
See.
So more than ever, these tax credits on the Arizona tax side are hugely needed by our charities and schools because they're not getting the donations like they have in the past. So it's one of the big changes for 2018. So,
wow. Okay,
yeah.
that's good to know.
Yeah.
Definitely have to look. I think there's a website we can go to check out what we can donate and where.
Yeah,
and all
you
that.
just Google Arizona state tax credits, and the public school is $400 for a married filing joint, and the charity organizations, and it has to be a qualified charity organization, but there are 16 pages, very small font, that you can look at online and pick your charity, local or some of them are statewide, some of them are local. But there's a lot of choices that you can donate up to $800. If you want to donate to various foster care agencies, that limit is $1,000 for married filing joint.
Okay.
And then the private schools, it's just over $2,000 that you can donate. And you can donate
amazing.
for a particular student at a private school or just to an agency that hands out money scholarship wise to those that need it. So.
That's awesome.
Yeah, so
It
those
gives
are
you an opportunity to take some ownership of where your tax dollars. You're going to spend the tax money anyway. You got to write that check anyway.
That's right. That's
so
right.
it gives you an opportunity to have a little bit more say.
Yeah, it does.
In where those go to, and help some organizations that you feel strongly about.
Absolutely. Absolutely.
Awesome.
Yeah, so it's great that they still allow us to do that.
Yeah, I love that. Cool.
Yeah.
All right. So
back to deductions, even though
yeah.
apparently most of us aren't taking any this year.
Yes.
I think that's one of the small business owner operators' favorite thing is how can I hide money from the government in things for my business and
right.
how to deduct income from my tax statement.
That's right. That's right. And it's
just a fun game.
It really is. And there's some gray area and there's some black and white area. as a CPA, I have to advise you of what the law says,
Of course. We
but
wouldn't expect
we
anything
want
else.
to make sure we take advantage of every single possibility that, as far as a tax deduction goes. So, and as a business, it's you can write off your toner that you're using at home and, things that you are using for your business. It's a great avenue to take the deductions that you can't as just an individual.
So like, I think one of the examples that we were talking about was renting a property that we own personally to the businesses that we own, and then using the rental money as a write-off to,
Right.
so like, getting creative on how to take advantage of deductions in a way that is super legal, but also, benefits both ends.
Right.
I think is magic if you can make it work,
Absolutely.
So getting creative and thinking creatively to try to make something work so that you can,
max out your deductions.
max them out. Get it done.
So speaking of rental properties,
yes,
I know we wanted to talk about a few things with that. And one of the main things as a rental property owner is that you get to depreciate the property. You can't take depreciation on the land, so you always have to break out what the value of the land is. But it's a great write-off. You're writing off your mortgage interest, your real estate taxes, any upkeep you have on it, but also a big piece of depreciation. So the catch-22 though with a rental property though is because it's a business property, a business you're running, when you do sell it, you have to be aware of capital gains tax and recapture of any depreciation that you've taken. So if you haven't lived in the property for 2 of the last 5 years, when you sell it, you're looking at having to pay capital gains on the profits. So it's a big formula, and you're going to reduce by selling costs, any real expenses of the sale, and you're going to take into account any capital improvements rather on the home that you've had, and try to get the capital gains taxed as low as you possibly can. But you do need to keep that in mind when you start to rent out properties. So
that is I want to put some major emphasis on the fact that if you're an investor and you are thinking about selling rental property, there is no disadvantage to using realtors because it applies against that capital gains implication. So
that's right.
And improving your property, capital improvements also. So if you increase the value and you're putting some stuff into it, I mean, it makes sense,
right?
Because it's all going to even out anyway.
In the end, it's beneficial.
It's beneficial. Sure. Yeah. I just think it's brilliant.
It's good, and that's what you do. So put your
plug
in there.
I know,
right?
it's so great. So
buy a house,
use
rent
a realtor. There's no reason not to if you're going to end up paying higher capital gains if you don't.
Exactly.
So I mean, it's just
take away the headache. The process so much easier.
I just think it's awesome.
So a rental property is a great investment. And I have a lot of clients that have properties, and it really is a great way to invest your money, and usually you're seeing that it's increasing in value. Obviously the market fluctuates. You can talk about that more than I can, but but it is a great investment tool. So
that's great. Well, I definitely think that there's a lot of really good improvements in our tax code it seems like there's some really great things.
There's a lot of change. It's simplified, but I think that the major thing is this tax credit for businesses this year is going to be what everybody's talking about.
Just on the fly question. Oh, see, it's going to get interesting.
Put you on your toes.
The whole 2 years before you have to be in the house for 2 years. Do you see anything in the future that has been put on the table that will maybe affect property owners? Do you think that in the future that the tax code might change? I mean, what's your opinion on it? Obviously you don't know, but can you see anything in the future that may change, or that is kind of on the horizon that may
I haven't heard anything like that. It's been this way for a really long time. And some people though will outsmart that and they'll just move back in for a while before they sell it.
Right.
I see that happen. And so that's a strategy to get around that. But as far as it changing, I guess I don't anticipate that. I haven't heard any discussion of that.
Okay.
But I know it catches people, it'll be their primary home and then they rent it out for 3 years and then they're in a situation where
they need to move back in so that they
some
are
people
For 3
will.
months.
For
Some
the 3
people
months.
will.
Yeah.
Well, you have to be there 2 of the last 5 years.
Yeah.
So
Yeah.
you have to kind of plot that out and on a timeline and make sure that you're not getting into a situation where you pay, because the capital gains is 20% and yeah.
No.
Yeah.
Don't
It's
do
a
it.
big ouch. It's a big ouch.
If you think realtors are expensive,
Yeah. And
Uncle Sam is way more expensive.
Definitely. And the other thing we could mention, I guess generally, I don't want to get into it in too much detail over a podcast because it is extremely complicated, but a like-kind exchange is a great thing if you're wanting to get out of one rental property, but you have your eye on another one. Look into a like-kind exchange. There's a lot of ins and outs. You have to be very careful to do it correctly, but you can avoid the capital gain tax and just kind of shift it to the next one. You're basically just buying yourself time.
Yes.
But it is great.
Yeah, the 1031 exchange is, I think that I take advantage of it while we can. I mean, that could change.
Absolutely.
They keep threatening to change some of that.
They do.
And, I think the key there, because I've done a couple of them for what helped with those sales.
Right.
And the key is to have, somebody who's managing.
An intermediary.
An intermediary, yeah, exactly. Somebody who is really making sure that never touches your bank account and that it's being done properly, so that when it goes to tax time and we hand all that information to you, you're not making a phone call and saying, "Oh, that's such a bummer."
Exactly. You had the money in your account. Oops.
Look what just happened to you.
Dear. So
I hate making those phone calls.
Yeah, exactly.
Yeah. So it's important to do those exactly right. It's one of those things where there's not a lot of leeway. So you have to do those exactly right and have the intermediary involved. So, but it is good.
That's awesome.
So, yeah.
All right, one more thing.
Sure.
Dodd-Frank. Do you know anything about Dodd-Frank?
I don't.
No?
Dodd-Frank?
Dodd-Frank Act. Do you ever deal with that for tax implication? No? Okay. Well, maybe we'll come back to that in a different podcast then, because I think that in itself would be a good topic to talk about because of how that is, tax implications for Dodd-Frank with investors. So we'll definitely have to bring that up.
There's storms on the horizon with that as well. So there's some interesting things coming down the pike.
Yeah. That'll change things, I think. So
100%. It's going to change things a lot.
Yeah. So
well, and a future topic.
Yes. Awesome. Well, thank you so much for coming in. This was fun.
Absolutely. It was great, and I wish everyone a great tax season. It's the dreaded time of year. Some people though like it because they get a fat refund, but I don't ever encourage you to rely on a fat refund. You're just giving the money up to the IRS.
Let's be perfectly clear. The federal government will never give you an interest-free loan for any amount of time.
Exactly.
So, don't do that.
Right.
As much as you can avoid giving Uncle Sam an interest-free loan.
It's not wise.
Yeah. Just take more of your money on payday.
Absolutely.
Yes. And have an accountant on your side to help you calculate that information well so that you don't get a huge refund.
Exactly.
So, good stuff.
Well, thanks, Dakri. We really do appreciate you coming on today.
Yeah, it was fun.
How can the people get a hold of you? For our YouTube viewers,
sure.
Your contact information will magically appear somewhere in this general vicinity of the screen.
Well, my website is suttonaccounting.com, and all my contact information's on there. So,
perfect.
Yeah.
Well, we'll get the word out and hopefully not make you too busy. I know you.
You
do occasionally want to go home during tax season.
A little bit. Well,
even if it's just
I work at home, so I never leave.
Fair enough.
I have a home office, so it's it's good and bad.
Awesome.
Yeah. Well, thanks for having me. I
Yeah,
appreciate
thank
it.
you.
Absolutely.
And thank you guys for watching. If you like the information, please hit that share button. We really do appreciate it. And until next time, I'm Kellen Hoskins. This is Chris and Maxwell, and we hope you're having a lovely day. We'll talk to you soon.
Bye.
Bye.